Hey guys, and welcome to Money Matters. I'm Chad Larson, Senior Portfolio Manager and founder of MLD Wealth. On Money Matters every month, we bring you on a deep dive of what's happening in global markets, asset allocation, and positioning strategies that we're deploying for our private clients. I'd instigated and sent out a note recently that we were going to do an allocators series, and I was going to bring on, as part of kind of the podcast, CIOs, portfolio managers, and allocators who are shaping how institutional and family office capital is deployed in real time. So we're going to call this Beyond Borders: Why International Equities Deserve a Seat in Every Portfolio. And then, the guest that we have today is Andrew Cox of Guardian Capital. I'm thrilled to welcome him to the show. Andrew's a senior portfolio manager at Guardian Capital. A little bit about Guardian. Guardian was founded in 1962. It's a global financial services company with client assets in excess of $160 billion, managing capital for institutional, private clients, high and ultra high net worth throughout its subsidiaries. They're based here in Canada, but they operate in the United Kingdom, United States, and the Caribbean. At Guardian, Andrew manages three concentrated equity strategies, including the Guardian International Equity Select Fund, a high conviction portfolio known for its structured process and global reach. Prior to joining Guardian, Andrew spent 14 years at Phillips Hager North, where he co-managed U.S. equity portfolios for both institutional and private clients. Earlier in his career, he spent time at Merrill Lynch in London on the global FX desk. He holds a Bachelor of Commerce and Honors in Finance and is a CFA charter holder. Andrew, welcome to the podcast.
Well, thanks, Chad. I look forward to chatting with you today.
Great. And so for people that don't know, this is our second filming attempt at this as my computer decided to do a hard reboot in the middle of it. So we're well seasoned and we're ready to go. But I've broken this into a few segments. Segment number one is why international equities and why now. And so I'll jump in. We've seen years of dominance from US equities, but international markets now are flashing a rare mix of deep value and improving fundamentals. At MLD Wealth, we're leaning into international exposure with real intent, and part of that is because of managers like Andrew. Andrew, what is your case for global equities right now?
Yeah, Chad, we think there's a few reasons why investors might want to consider international equities at this current juncture. And one is benefits of diversification. So, markets in Europe and Asia, for reasons of differing economic cycles or currency movements, have an imperfect correlation with North American markets. So, they add diversification benefits that way. They have a very balanced mix of stocks in these markets. So, the benchmark we use for this fund is called the MSCI EFI Index, and it's a benchmark of roughly 700 stocks across 21 countries in Europe and Asia, all developed markets. And the largest constituent company is under 2% weight in that index. And so that's a contrast to North American indices where the biggest stocks might be 6 or 7%. Or put differently, the top 10 stocks in that market in EFI are under 13%, whereas, say, in Canada, the top 10 might be more like
Yeah,
35%.
that's interesting. Like, so much discussion is around, the Magnificent Seven in the US and how much the tail can wag the dog with just a handful of companies. And so as much as you're broadly diversified, say in the S&P 500, the top seven names make up a significant chunk. And equally that in Canada. We've got a couple big banks and, it's a very concentrated market. I didn't actually even know that the top 10 positions in Canada are more of a concentrated than even in the S&P.
Well, indeed, that's right. Yeah, so that's one thing we don't get when we're trafficking in the EFI market. So I think that's a positive attribute there, where there's a nice mix of opportunities across a whole host of countries
Yeah,
and sectors.
You know,
Yeah.
you mentioned 21 countries. Like the world's a big place. For viewers and listeners, what is EFI? It's our jargon in finance, but it's Europe, Australasia, and the Far East, and they're the most developed geographical areas in the world outside of the United States and in Canada. So, we'll dive in here a little bit further. So, thank you, Andrew. Um, Segment two is MLD wealth manager selection and due diligence. So I've always preached, an MLD manager selection is core to how we serve clients. We don't just look at past performance, we dig into process, consistency, and philosophy. I've made a career out of talking about people, process, and philosophy as the good P's, and products, price, and performance, not being the negative ones, but in an industry that leads, looking in the rearview mirror so far. So we apply both internal scrutiny and third-party diligence, working with external consultants like ACG with our alternative private income portfolio to perform deep risk attribution and forward-looking assessments, but internally as well, at CG looking through that. So your strategy really stood out to us for three reasons. That's where we dove in. So we'll spend some time there. Number one, your discipline process. If we could talk about the quadrant system a bit, and then we'll dive into your conviction-led approach to only 15 to 30 names and your ability to protect capital and with high return on equity and a clear self-discipline. So tell us more about the Guardian process.
Yeah, absolutely. And as you mentioned, Chad, it's called the Quadrant System, which is really a fundamentally supported approach. So it's based on in-house research we do here at Guardian. We spend our days analyzing financial statements and meeting with companies to write our own research reports. And some of the key output from those reports is to make projections on a variety of financial factors, such as the sustainable dividend payout ratio and profitability for each company. And our main key attribute for profitability is return on equity. So it's a return on equity based approach. And we use those projections to formulaically plot stocks versus the stock market on two factors, those being valuation and growth rate. So those are the two axes of the quadrant system. So the key focus for us is to construct and maintain a portfolio, which is always in what we call quadrant one. So it's the quadrant where you have below market growth, but above market growth rate. Or sorry, below market valuation, excuse me, above market growth rate. So that's quadrant one. So it's intuitive appeal there if you stay in that quadrant, and we think it should help your performance odds over time, basically. So it's a very fundamental, thoughtful approach, and we do our own research, but it has the benefits of, when you do your own work, you can run a higher conviction portfolio. So we're certainly diversified by country and sector, but again, out of the 700 stocks in that benchmark, we currently only own 25, and so you can only really have that kind of portfolio if you've got that level of conviction.
Yeah. I'm going to go on a little bit of a tangent here a little bit. I didn't really plan on this, but years ago, like we've traded and positioned ourselves very well in the gold market, and that's obviously been a very topical trade here. And how we did that was we started, call it lacing up our boots or putting our shoes on, so to speak. We started with a position in Boolean just to be there. And as that segment started to gain traction, we saw strong flow and conviction. We knew that, perhaps the new lower lows and the higher highs were translating, and that we had a cycle and a market coming up here, aside from all the other input factors on geopolitics and fiat currencies. Then we kind of came down and we said, well, let's just get market exposure. Let's just buy the index and get that exposure. And as that market has developed, we've parlayed that down further and saying, okay, now we see potentially an M&A cycle and the mid caps and juniors starting to be in play for that next segment of the market. We had started positioning into international equities just by beta indexing, across as low cost ways to access international markets. But I'll probably get further in the presentation. It was why the active management and why now, and we'll dive into that because we do believe that active management will outperform with select managers when the market cycles make sense. So thank you for that. We'll circle back. Let's talk a little bit in the next segment here around sector opportunities and some macro themes. You've taken some strong positions in sectors like defense, capital goods, utilities, medtech, and these all align with big macro trends and trends that I've been talking, ad nauseum about over the last year is, energy transition, AI, defense, infrastructure, geopolitical realignment. Can we break it down a little bit? Maybe give some interesting comments around some of your overweight positions.
Yeah, and absolutely. So I'll give you a few examples. I mean, one might be BAE Systems, previously known as British Aerospace. So it's a UK-based defense contractor, half operates in the US and half sells equipment into Europe. And there is a big transition or push underway in Europe to allocate more dollars towards defense budgets and improving their defense infrastructure, if you will. So it's really an end to the prior 3 decades of kind of peace dividend, if you will.
Yeah.
And perhaps underinvestment amongst European nations.
Probably off the back of Trump saying he doesn't want to police the world, and kind of
Yeah,
putting people's feet. We're seeing that in Canada as well.
that's right. Absolutely, same thing. It's indeed, and so it could be long lasting, and it could have a reasonably big magnitude of impact on a company like BAE, which makes a variety of products. They make the Bradley fighting vehicle, like a small tank, if you will. They make the Eurofighter, called the Typhoon fighter jet. And nuclear submarines are a few examples of products they make. And so the impact could be quite substantial. I mean, as an example, the Typhoon fighter jet was really kind of coming to the end of its expected
Mhm.
life.
Yeah.
There was about an order book remaining of about 30 jets to deliver for BAE. They produce about one a month, but they recently indicated they've had indications of interest for another 200. So
Wow.
that's a reasonably big impact. Similarly, in nuclear submarines, where the current program in the UK is coming to an end, but the UK government just announced they potentially could order 12 more, and that's big ticket items. It's
Yeah.
well over £1.5 billion per submarine. It takes years to build these, so we're talking about decades, potentially decades more work for BAE. So
Order flow.
so that could be
Amazing.
quite big. Yeah, that could be big. In terms of infrastructure, Siemens might be an interesting stock here. There was a change of government in Germany, which very quickly announced a 500 billion euro infrastructure program, part of which will be allocated to improving the rail network. So historically, Germany's had the lowest per capita investment in their rail network, but of the 500 billion, 100 billion is going to go towards railroads by the looks of it. And so that will make their spending from the lowest in Europe to the highest. And one third of Siemens is actually its rail equipment, infrastructure, control systems, signaling, the locomotives themselves. So that could be a long-standing tailwind for a company like Siemens. And then thirdly, in terms of energy transition, National Grid is a UK utility. They don't produce electricity, but they transmit it
Yeah.
across the country. And the UK
So they fall
is
into that
very,
infrastructure bucket as well.
that's exactly right. And so they earn a regulated return on expanding that infrastructure.
Mhm.
And the UK, by geographic circumstances, very close to the North Sea, which is very amenable to wind power. So there are big plans to grow. They're already a sizable wind power base, but it's going to grow another 60% according to plans. And so every turbine will need to be connected back to the mainland, and that's all future profits for the national grid. So those are some, we think, promising situations that should capitalize on these what could be kind of long-term trends. Yeah.
That's amazing. I think that's lots there. We're not going to totally get the whole playbook from you. But it was really nice for listeners, viewers, investors to kind of get some insights into kind of the pragmatism of how you're looking at fund flow and long-term trends and how they impact the portfolio. I wanted to talk about kind of in this next segment, we called it country allocation, what's driving returns. Many investors worry about macro overhangs in Europe or stagnation in Japan. But when you dig into the company level data, the story changes. You've got names like Murata or Tokyo Election in Japan that are global leaders. What's exciting you, at the country level for some countries? I guess maybe we'll talk about Japan if that works.
Yeah, absolutely. We could focus on Japan, where, rather amazingly, that market peaked in 1990 and then had disappointing performance for 30 years, but it remains the third largest developed market in the world, which is quite something, a testament to its size. And there's a large campaign of structural, like corporate governance reforms underway there, imposed by the Tokyo Stock Exchange, where they are really pressing companies to add more independent directors and sell down legacy cross shareholdings in other Japanese corporates and present a plan to improve their return on equity over
Was
time.
that
So,
something that you saw structurally in Japan, like a lot of kind of like conglomerate holdco style public companies where, the sum of the parts, you never really knew what was going on, where the attribution was,
well,
and they were all
indeed,
just playing with each other?
that's right. That's exactly right. It's a historical business convention that they own shares in each other, and so the long-standing, you're right, corporates in Japan have shares in Nintendo and Sony and all the Toyota, you name all the sort of household names, if you will.
Yeah.
But finally, there's an impetus to sell those shares,
Yeah.
either use the profits to grow your business or return them to shareholders. So it's having a meaningful impact on a lot of stocks in Japan. And as you mentioned, yeah, you've highlighted two great ones. Murata is I think I find Japan is a country with a lot of unsung champions and a lot of technology and industrial industries. Murata is a great example where it makes 40% of the world's ceramic capacitors, which are small components that ensure the smooth flow of current in a variety of electronics, but with some very growing end markets like electric vehicles and AI servers, for example, where they have an even higher market share,
Mhm.
actually. So well placed in that regard. And Tokyo Electron is a leader in semiconductor production equipment. So there are very few companies in the world that do what they do. It's very specialized equipment. There's obviously a great long-term growth and demand for semiconductors, and specific to Tokyo Electron, they are a leader in the specific varieties of equipment they produce. So, for example, They make a coater developer, which is one step where you add photoresist to the semiconductor wafer.
Hmm.
And they have a 90% market share for that product. And for leading edge varieties of semiconductors, their market share is actually 100%.
Wow.
So yeah, two
Real
great
high
companies.
competitive moats
Yeah. Oh, very
and
high. Yeah,
valuations in line.
absolutely. Yeah. And great balance sheets and high return equity, high profit margins. So they're two great examples of reasons why I think Japan is a market very much of interest to us. Yeah.
I guess, I'll pick your brain while I've got you, and unlikely you'll say no to me, but can we talk maybe a little bit about France and Germany, kind of the industrials and consumer resilience, and maybe just dovetail off the back of what we talked about infrastructure and Siemens, but are you seeing
Yep.
things across part of the Eurozone as well?
Yeah, yeah. So the Germany was really first out of the gates with that large infrastructure, bill, which I said, as I mentioned, could help Siemens, but it could be, first of all, followed by other countries. So the UK's come out recently with another $725 billion infrastructure bill. That's for roads and highways and so forth. And part of that, part of this German bill, for example, is allocation to clean energy
Hmm.
investments. So I mean, it could help companies like, say, Air Liquide. So that's an
Yeah,
industrial gas company in France, which has a rather unique hydrogen pipeline network. And there are very sort of nascent plans to develop a clean hydrogen economy there. But if they do expand and take off, it's the natural sort of participant in that. So yeah, so there's a lot of country-specific sort of tailwinds, I think, for some of these stocks in Europe as well, which could be quite beneficial.
amazing. Thank you. Segment five, sell discipline and risk management. With concentrated strategies, risk control is everything. I was really impressed by, your clear exit framework. You trim when quality fades, when valuations get rich, and when portfolio metrics diverge from your mandate. We'd kind of talked in the first run of this, around that quadrant system a little bit. It's like doing the simple thing repeatedly, but you have to have discipline around processes. Again, they're really looking for, companies with below market valuations with above market growth expectations. But, talk to me a little bit about the discipline when portfolio metrics diverge from mandate. And can you walk us through some of your sell discipline?
Yeah, absolutely. So we actually have like two levels of thinking when it comes to sell discipline. So there's at a stock level, we will reassess if there's changes to quality, growth, or valuation. And quality and growth, in our experience, are very low twitch factors, if you will. So
Hmm.
they will change maybe infrequently, but it takes a lot to make them change. So they're more stable, whereas valuation changes all the time in the market. So we track that methodically every day for all of our stocks, and we'll watch them as they migrate around the quadrant system effectively. And so if they change quadrants, that will prompt reassessment of a position for sure. So that's one level of thinking. And then there's a second order to it for us, which is at the portfolio level. So on the same measures of quality, growth, and valuation, but as long as the portfolio is high quality and within quadrant one, again, with an inexpensive valuation, but better growth, then we find ourselves feeling reasonably sanguine about the stocks that we own. And it's sort of having that second lens to our sell discipline, we find helps sort of keeps the temper the transaction volume, if you will, and sort of keeps a steady hand on the tiller for our
Yeah, keeps
clients.
everyone honest, right?
Yeah, yeah, absolutely.
Amazing. Segment six, kind of some final thoughts. And at the end of the segments, I might rapid fire you a few questions. But why this allocation makes sense now. I'll start to close this by saying exposure to international equities is no longer just about diversification, but it's also about opportunity. The US is led, but leadership rotates, and investors who wait for momentum to confirm often miss the compounding window. This is one of those moments where international offers better value, better quality, and lower correlation risk. And we're proud of our partnership and managers like Andrew and Guardian in navigating that. So over to you on on why now again.
Yeah, absolutely. And I think exactly to your point. I mean, certainly recent years, there's been a spectacular run in US stocks, and it's been some wonderful investments there. But maybe it's important just to help frame that recent outperformance amongst a longer term history. And if you look at prior decades prior to this decade, so actually the five prior decades from 1970 to 2020, the performance of international stocks, EFI stocks versus US stocks is highly similar. It's
Okay.
highly similar. So that's maybe a helpful framework just for reference when you're looking at the current disparity in performance.
Yeah.
And then secondly, I'd say it's important to just mention there are a lot of very unique investment opportunities in the EFI market. So if you're looking for the global leader in a range of very sort of promising industries that span, pneumatic components to luxury goods to robotics to flavors and fragrances. You need to invest in companies in Europe and Asia. They're not available in North America. So I think that presents, a compelling case to consider EFI at this time. Yeah.
Amazing. Thank you. Again, well, I guess why I got you, a bit of an optional segment, but a bit of a quick fire round. So I want to wrap it up with a few fun, quick fire questions. So kind of first thought or best thought, most underappreciated international market. So first
Okay.
thought,
Okay. I'll go with Denmark. It's a country with a population actually slightly smaller than Toronto, but
wow.
has a preponderance of global leaders in industries that go from, beer to logistics to medical devices. Yeah, a wonderful business culture. Yeah.
Amazing. One sector with the most upside over the next 3 years.
I'll go with healthcare. That's been a difficult sector for about 3 years now.
Is that
Partly left.
healthcare or health tech?
Well, it would be. I mean, that's a good point. I mean, it straddles the line sometimes, but
Yeah.
certainly there's a lot of pharmaceutical and device companies, with a technology element to it, I guess, which are have been left in the dust, and partly as they're viewed as defensive stocks, partly perhaps there's debate about drug pricing, but some wonderful companies in there, and the valuations are now extremely reasonable.
Okay. Global CEO you trust with your family office. Who have you met along your journeys that really stands out that really gets no time and attention? I guess all we talk about here is Elon Musk and Warren Buffett and a handful of other and Jeff
Okay.
Bezos.
Okay. Let's see. So family up. So you're looking for someone who's probably both prudent and has a very sort of long-term perspective on investing. So I'll go with Bernard Arnault, who's the founder and CEO of Louis Vuitton, or otherwise known as LVMH,
Mhm.
who from 40 years ago, started from scratch and has assembled a portfolio of wonderful brands like Bulgari and Dior and Tiffany, which he certainly manages not for short-term profitability, but to make sure they are relevant for generations to come.
For legacy. Yeah, no, that's a great answer. Most misunderstood risk in international investing today.
Yeah. Okay. So for this one, so I think the most sort of unappreciated risk is actually an upside risk to stocks in China and the Chinese economy, where I think, it's well known, it's been slowing for a long time. It's been a difficult stock market for a long time. And I think it's assumed that that will continue. And I just wonder if there are some small hints coming out of that economy, everything from gaming revenues in Macau to low interest rates supporting the commercial property market finally, that I just wonder, and the valuations are extremely low. I just wonder if the main risk is that people have set aside stocks exposed to China, and perhaps they might be more promising than what people think.
Yeah. Kind of last one, it pains me to bring this up because it's kind of all I've talked about for months in the podcast. But, with tariff announcements getting headlines regularly, what are the main points of tariff exposures across EFI stocks, and what sorts of impact is the uncertainty having across the EFI? And is that largely behind us, or is everyone becoming more of a nationalist than global?
Yeah, sure. So, I mean, there are certain industries that are more exposed than others. I mean, of course, some are. Uh, it's hard to change your source of supply. So, for example, if you're making cognac or
Mhm.
champagne, it must come out of those regions.
Right.
You can't find an alternate supply source to sell it into the U.S. So,
Yeah.
there's a few industries that are in the crosshairs. They're just going to have to work their way out of it. But by and large, there's a lot of trade amongst these countries that, not necessarily with the U.S., but of course in between, Europe and Asia and so forth. So the exposures are actually quite reasonably manageable across the markets. I would say that as a group, there's predominantly trade amongst European nations, and perhaps even more so as we go forward in a response to, again, as a counter to pro-American policies, there might be more pro-Europe and intra-Asia policies, if you will, which will actually help navigate that tariff risk going forward. Yeah.
Awesome. Thank you. Listen, Andrew, thank you so much for joining us. This was a great segment to our listeners. Feel to reach out to myself with any comments or questions you might have for follow-up. I'm happy to share parts of the Quadrant system with you. The visual aspects of it really are quite compelling to that. You can always Google or visit guardiancapital.com and reach out. This has been Money Matters and Allocator's Perspective. Again, thank you so much, Andrew. Keep doing the great work you're doing for our clients, and we'll talk soon. To everyone, have a
Absolutely.
wonderful month.
Thanks very much. Thanks.
Cheers.
Take care. Thanks, Jeff.